Hello students and welcome to the lecture. So students, as we know that we are covering the key national institutions, and in the previous lecture we had started the Reserve Bank of India. We have covered the history, what were the scenarios, how the Reserve Bank of India and the State Bank of India was established. Okay, so in this lecture basically we are going to continue with the Reserve Bank of India and we will cover some more facts and figures related with the topic. So I hope that you are excited because I am excited too. So let's start this lecture. So now we are going to talk about the functions of the Reserve Bank of India. What are the functions discharged by the Reserve Bank of India as an apex banking institution? Okay, so the first function is the monetary policy. So students, basically there are two types of policies. Fiscal policy and the monetary policy. Fiscal and the monetary policy. Two types of policy we have. Now the question is, what do you mean by the fiscal policy and what do you mean by the monetary policy? So first let's talk about the fiscal policy. So basically the fiscal policy is made by the Ministry of Finance. Okay, and it is famously known as the budget. Okay, you must have heard this name in the news very time. Every year during the last Feb or the first of the March week, I'm talking about the week, okay, not the day. Okay, finance minister come to the parliament, they announce the budget, like how we are going to do in this year. Okay, that's are the things. So it is known as a budget and it is basically mentioned as a annual financial statement under Article 112 of the Indian Constitution. And it is very interesting to see that however you heard this name many times in the news channels, but the interesting fact is this: there is no word like budget mentioned in Constitution. How interesting it is. Like we had heard the budget. We even say, oh, the finance minister has come to announce the budget. But there is no word like budget mentioned in the Constitution. Under Article 112, the finance minister has the power to announce the fiscal policy, but not in the name of budget, but in the name of annual financial statement. Remember these points. Okay. So now come back to the topic. Annual financial statement, or you can say the fiscal policy, is basically about how the government will earn, or how the government will spend. Okay, so the total plan regarding this thing is mentioned in the AFS, Annual Financial Statement. Okay, remember this point, and it is done by the Ministry of Finance. Okay, it is totally about the expenditure and revenue. Alright, now come to the monetary policy. Monetary policy is basically the money circulation. It's basically the money circulation in the economy. Okay, so the primary function of RBI is to formulate and implement monetary policy aims to control inflation, stabilize price, and promote economic growth while maintaining price stability. Now, I hope that you have got an idea who made the monetary policy. It's the Reserve Bank of India, and basically it is the money circulation. It means that the money circulation should be in accordance with the demand and supply rule, because if the money in high circulation, it means that there is less demand and high circulation. What will happen? The economy will start the inflation. And how it is possible? Let me tell you very clear. Like suppose I only need rupees 10 to follow my, you can say, to spend my money and to live my lifestyle. But because of the high money circulation, I received rupees 20, rupees 30. Okay, I had only demand of 10. I receiving this kind of money, then what will happen? First, the value of the rupee will go down. Second, the inflation will goes up, because when I have the excess money, then I will try to spend it more and more, and this will lead to the more money circulation in the market. And when it's happened, not only the value of the money will go down because it is in the less demand and the high supply, but also the money circulation will rise up. Okay. Second, if we talk money in low supply and high demand, there will be a deflation. It means that there is less money in the circulation, which will lead to the deflation, or you can say a recession. Okay, like I need rupees 20 to live my lifestyle, but I only receiving rupees 5. Then what will happen? I could only spend rupees 5 instead of 20. It means that the purchasing power of mine is going down, and this will bring a less money circulation and the deflation. And the both the situation, inflation and the deflation, are not good for the economy. So this should be a equilibrium. Like if I need 20, then I only must have 20 rupees. So there will be a stable money circulation in the market. There will be a no deflation and inflation. This kind of things has to be ensured through the monetary policy, which is formulated by the Reserve Bank of India. Now, come to the next point. It is the currency issuance. RBI is the sole authority responsible for issuing and managing the Indian currency, coins and banknotes. Okay, so you can say whatever currency you are using in the Indian denomination, or you can say in Indian INR. You must have seen this word many times. Okay, like if you have gone to the supermarkets, you must have noticed that it is written down rupees 10 NIR. Okay, what does it mean? It means that Indian National Rupee. Okay, so whatever note you are using, bank notes like rupees 10, 20, 50, 100, 200, okay, 500, 2000 is not in the circulation right now. Okay, so whatever notes you are using in the Indian denomination, remember in the INR, it doesn't mean that you are using rupees 10 of PNR, Pakistan National Rupee, and then you are saying why it is not issued by the RBI, because RBI is the Central Bank of India, not the Pakistan. Okay, remember this point. So whatever banknote you are using for rupees 10, 20, 30 and whatever it is, they all are issued by the Reserve Bank of India with the signature of governor of the bank. Okay, and basically if we talk about the governor of the bank, then let me tell you one thing. RBI having one governor and 4 deputy governor. Okay, now remember one thing also. Remember one thing also. 1 rupee or rupees 1 note not issued by RBI. Okay. All the other denomination notes in the Indian currency could be issued by the Reserve Bank of India, but rupees 1 note is not issued by the RBI. It is issued by the Financial Secretary under Government of India. Okay, remember this point. Now let's move forward. Banker to the government, what does it mean? RBI act as the banker and debt manager to the central and state governments, manages their accounts, facilitates borrowing and lending, assist in the management of public debt. Basically, government also required the banking activities to functions. Let me tell you example. Suppose now the government announced that they will expand rupees 100 crores during a certain year. So it is the expenditure of the government for the economy. Okay, but they only had a revenue of 20 crores from the previous year. In this scenario, they having the deficit of 20 crores and they required 20 crores so that they could spend 100 crores as promised in the annual financial statement, right? So what the government will do? The government will borrow rupees 20 crores from Reserve Bank of India. Okay, that's how it's function as a government's banker. Second thing, if government required any financial advice, advices, then RBI gives it to the government. Okay, whether the central government or the state government. Okay, and if we talk about the government's account, like if the government is operating, they must have some bank account. Okay, so they having the bank account in RBI and on SBI, State Bank of India, because SBI also work as an agent of Reserve Bank of India. Okay, so remember this point. Bankers Bank. So RBI is a centralized bank and the apex institution in the country to manage the banking structure. So what does it mean? It means that it is not only having the responsibility to help the government, but also to protect the banking structure of the economy. Okay, that's why it is also known as the Bankers Bank. Serves as a banker to the banks operating in India, provides them with services like maintaining cash reserves, clearing and settlement of interbank transaction, and acting as a lender of last resort. Let's discuss them. Cash reserves, I will tell you in this lecture later on. Right now, if we talk about the clearing and settlement of interbank transactions, suppose there is a A bank and there is a B bank and there is a C bank. Okay, A borrowed rupees 10 crores from C. Banks generally do it. Okay, then A also have to return C also have to return rupees 10 crores to the B as it borrowed somewhere else. Now 10 crores borrowed by the A and C has to pay 10 crores to the B for the loan it had borrowed in a long time ago. So C asked A not to return the money to C but to return the money to B. Just an example. Okay. In this scenario, what is it? It is an interbank transaction. Clearing and settlement. Okay. In this scenario, A borrowed from C. C had already borrowed from B. C asked A to return the money to B instead of C. So, is this thing done or not, and what are the problems if occur? All these things are monitored by the Reserve Bank of India because it is an apex body and guardian of the banking system. Okay. Similarly, it is a lender of last resort. Suppose if there is a bank A which is about to insolvent and does not having enough and sufficient money to carry on. In this scenario, this could borrow money from Reserve Bank of India with some special kind of conditions. Okay, that's why it is known as the Bankers Bank. Supervision and regulation, it is very necessary. RBI oversees and regulates banks and financial institutions in the country to maintain a stable and sound banking system, sets rules and guidelines to ensure the safety and integrity of financial system sector. Like RBI is the top authority. Now we having the banks like A, like B, like C, like D, like E, like F, like G. Many banks are operating in India and there is a huge consumer base. Okay. Now what happened? How to check these banks are doing the ethical working or not? What are they doing? And if you had watched a series of Scam 1992, then you must be aware about how the RBI supervises and regulates the banking system. RBI ensured that there should be the ethical practices by the banks to be done. Okay, that's why it supervises and regulates by formulating the guidelines to comply with. And if any banks falls or fails to comply with the guidelines, the RBI will take a appropriate action as prescribed. Okay, so that's why it is very necessary. Now let's move forward. Exchange control. Basically, RBI is the custodian of foreign exchange in the country. Foreign exchange basically stands for the foreign currency we have in the country. Alright. So RBI manages India's foreign exchange reserves and formulates policies related to foreign exchange control to stabilize the value of the Indian rupee and promote international trade. How does it form? Let me tell you. Suppose RBI want to issue rupees 100 crores currency in the market, but somehow the currency reaches rupees 150 crores. In this scenario, there is a low demand and high supply, the value of money will be goes down. Then RBI could use foreign reserve, which is also known as forex. Okay. Then they will buy rupees 50 crores back from the market. Okay. So now if they are buying it back, then they must have to give something in return. That's the rule. Suppose if there are two persons, you have to buy something from him, then you must have to give something from him, something to him. Okay. This is called a transaction. Right? Same thing happen like this. We always maintain a forex reserve of USD, which is also known as United States dollar, which is an international currency. Okay. So if RBI will buy rupees 50 crores back from the market, it will provide US dollars equivalent to 50 crores rupees in the market. That's how the RBI regulates and stabilizes the currency market by using the forex reserve. They buy the money back from the market if in the excess by issuing the dollar. And you can say they start buying dollars and issue the rupee if the rupee in the less circulation. Okay. It's also promote the international trade because as I have told you, US dollars is the international currency. Okay. Suppose if it is the country A and it is India. India is doing a trade with A. Alright. Then A will not accept the Indian rupees until or unless we had signed an agreement with them. Because how and where it will spend this money? But they can accept the US dollars because it is the international currency. That's why the forex reserves are important for the international trade. Developmental functions. RBI also engages in various developmental functions to promote financial inclusion and support economic growth, initiates policies and schemes to enhance the reach of banking services to under-reserved areas and communities. Basically, financial inclusion means everyone in the country must have right to the bank. Must have right to use the banks and having the banking facilities, right? It is the financial inclusion because various schemes running by the government, so the money provided in these schemes are directly transferred into the bank accounts of the beneficiaries. But if the beneficiary does not having any bank account, where the money will transfer? That's why the financial inclusion is necessary. And RBI works for it. Time to time, RBI asks the banks to formulate a special kind of policy for the financial inclusion. And also RBI reviews and recommends the solution if required. Okay. Thereafter, if we talk about the organizational structure, RBI operates under the guidance of Central Board of Directors. The board consists of the governor and up to the 4 deputy governors, all appointed by the Government of India. As I had already told you, governor is also the chairperson. Also the chairperson of RBI and 4 deputy governors. They all are a part of Central Board of Directors who maintains the organizational structure of the Reserve Bank of India. The governor is the chief executive of the Reserve Bank of India and represents the central banks in various national and international forums. Okay, because he is the main head. And whenever India represents its financial system, RBI basically goes as a chief representative and chief executive officer, means the governor of the RBI will represent the India's stands in national and international forums. Okay. RBI has 4 functional departments. Departments of Currency Management, Department of External Investment and Operations, Department of Government and Bank Accounts, Department of Economic and Policy Research. Okay. Now the monetary policy tools RBI use. First is the repo rate at which the RBI lends money to commercial banks against government securities. Changes in the repo rate influence borrowing and lending rates in the economy. Like banks are providing the loans to the people, and people are using that loan in the market. This can increase and decrease the Indian rupees flow in the market, okay, which will ultimately affect the country's monetary policy. That's why RBI maintains a repo rate. Basically, banks could borrow from RBI on the repo rate. And if the banks borrow, they have the funds. And if they having the funds, they will lend the fund to the people. When the people will get money, they will spend in the market. That's why RBI increase or decrease the repo rate as per the condition. They increase the repo rate during the inflation and decrease the repo rate during the deflation. If the repo rate is increased, it means that it is kind of interest. If the repo rate increase, the bank will avoid borrowing from the RBI. Okay, and when they do not have fund, they cannot lend the loans. It means that public will not have enough money, will not have access money to spend in the market, and currency flow will be smooth. Okay, and inflation will be counter. In the second condition, if there is a deflation, then the RBI will decrease the interest. If the interest is decreased, the banks start borrowing from the RBI, and when they borrow from the RBI, they generated the fund, and that fund will be transferred to the people in form of loan, and then the people will start spending the money in the country economy, and the currency flow will goes up, and the deflation will be counter. Okay. Reverse repo rate is basically when the RBI borrows money from the commercial banks. Changes in reverse repo rate impact liquidity and banking system. It is also decreases and increases during the inflation. In inflation, it is increases, and in deflation, it is decreases. In the previous scenario, RBI gives loan to the banks. Okay. In this scenario, RBI taking the money from the banks. In the previous scenario, the banks has to pay the interest to the RBI. In this scenario, the RBI will pay the interest to the banks. Okay. So suppose if there is inflation, there is a huge money circulation in the market. So RBI will increase the reverse repo rate. It means that if banks give their money as a loan to the RBI, they will receive a high interest. Then bank will start providing the money to the RBI, and this will reduce their fund, and when the fund will reduce, their loan capacity will reduce, money holding by the public will reduce, circulation will reduce, inflation will be counter. Okay. Similarly, if there is a deflation, the RBI will decrease the interest or reverse repo rate. That's why the bank will not so happy to provide their money to the RBI, because now they are getting the less interest. And when they holding the money, they having the funds, they will grant the loans, people will have the money, people will spend the money in the market, and the deflation will be counter. So that's how the repo and the reverse repo work. Thereafter, cash reserve ratio, CRR. It is a percentage of banks' net demand and time liabilities that are required to keep a reserves with RBI. Adjustments in the CRR affect the money supply in the economy. Suppose there is a bank A. It's having rupees 100 crores deposit with it. So the A could not lend entire amount as a loan. No, because people who had submitted their money to the bank and deposited their money to the bank may require a money at every time. And if A granted the entire money as a loan, it will having no fund when the people come back to withdraw their deposit. So to counter this kind of situation, RBI asks the banks to maintain the cash reserve ratio, CRR. It means that if 100 crores holding by A, then at least 15 crores, just an example, will be given to the RBI by the bank. Okay, now it will having only rupees 100 crores deposit left with him. Okay, so in condition, if 85 crores has been lended out as a loan to the people, and then the depositors come to A and they want to borrow their money, so A could use these 15 crores because now entire amount has been lended off by him as a loan, which will be returned after a certain period of time, not immediately, because loan is taken for a certain period. Okay, now the statutory liquidity ratio, it is the percentage of bank's net demand and time liabilities that they must maintain in form of specialized liquid assets such as government securities. It influences the money supply. Out of the 85 crores left with the bank after giving 15 crores as a cash reserve ratio, even the bank could not lend out 85 crores to the people as a loan. It had to submit some amount as a statutory liquidity ratio. Like RBI asks, at least 20 crores you should keep with yourself as SLR. It means that 85 minus 20, now only 65 crores left with the bank to lend out the loan. This is the SLR. So remember, if the bank having the 100 crores, it could not let out entire amount as a loan. First, it had to submit the CRR with the RBI, then it had to maintain the SLR with itself, and then the remaining amount could be lended as a loan to the people, so that the bank will not become insolvent in the nearby future. Okay, because suppose if they lend it out entire amount, the people will come, ask where our money, and the money will be returned to the bank after a certain period of time. Meanwhile, where the people will go? Because they had submitted their money for some time. So to prevent this kind of condition, RBI asked the banks to maintain the SLR and CRR. Okay, now we have the MSF. It is marginal standing facility. Allows bank to borrow overnight funds from the RBI against eligible securities. MSF rate is higher than the repo rate and act as a panel rate to discourage banks from excessively borrowing from the Reserve Bank of India. Suppose there is a bank A which had rupees 65 crores left after deducting the CRR and the SLR. Now they are lending the amount as a loan excessively. Okay, what will happen? After some time, they are left out with amount, but they required a immediate funds. For their proper functioning. What they should do in this condition? Then they could reach the Reserve Bank of India to borrow a money, marginal standing facility, overnight. It means that if on 1st March they had faced a shortage of the funds, they borrowed the money from RBI, then after the 2nd March they had to return the money to the RBI. It is only for the 1 day period or the overnight period. Okay, and even it is at the great interest. Like suppose if on the other borrowing options 7% interest charged by the Reserve Bank of India. So if the banks goes under MSF, nearly about 12% interest will be charged off by the Reserve Bank of India. Now you can see Higher is the interest rate RBI demanding from the bank if banks comes under MSF. Why? To discourage the excessive lending. Okay. So this is about the MSF. So students, basically in this lecture, we have completed the Reserve Bank of India. We have discussed the facts and figures about it. I hope that you have enjoyed the lecture. You have come to know about various facts and figures. In the next lecture, we will start with another important key national institution. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.